What's going on, guys? Welcome back to the channel. So the Fed's done it. The Fed has released another 25 basis point rate hike on the economy. And the economy is what the Fed is trying to slow down. And I've had a lot of different conversations with different people in the comments, emails, people messaging me, asking me, hey, Ron, should I stop my 401k? Should I pause my 401k contributions? Should I stop investing in the stock market? I don't know what's going on. Inflation is still out of control. But guys, I want you to just take a second, just take a breather. I don't think that the world is ending. I really do not think that the world is ending. In fact, I think that the Fed may be making it way easier to get wealthy. And I know that the Fed has issued numerous warnings. In fact, the Fed's warnings have started probably nearly 2 years ago, if you think about it. But the very interesting thing about this whole inflationary problem that the Fed is dealing with, as the Fed raises interest rates, they're pretty much in line with what the Fed has warned us about going into this thing. The Fed warned us that, number one, inflation is too high, but number two, they're going to be coming after unemployment. They're coming after unemployment. What they're doing, and I apologize for the sweaty t-shirt. I just wrapped up a cardio session in the home gym here, but I wanted to get this message out to people because I think right now is one of the greatest times to build wealth, and I'm gonna get to that later in this video. But the Fed has told us that the jobs market is too hot. Now, their goal is to raise unemployment to somewhere around 5%. Well, let's just call it 4.5%, right? Now, if you look at where unemployment is now compared to where their target level of unemployment is, that's about a million and a half more jobs that need to be lost. However, leading up to this point, the Fed has issued just countless warnings. Hey guys, jobs are going to be lost. There's going to be softening in the labor market. We hear this all the time. But here's the thing. The Fed raised interest rates just yesterday, 25 basis points. And the market, the market was actually positive initially, or at one point during the day, and then it eventually sold off. But we ended up seeing some big name stocks drop a point or two. But it really wasn't this massive major sell-off. So to me, I feel like the market really doesn't have any clear direction in terms of, should it go higher, should it get lower? The thing is, though, I'm interpreting this as the fact that the market is kind of confused and is undecided. And the reason why is because there's a high degree of uncertainty. Is the Fed raising the interest rates by 25 basis points as opposed to, say, 50 basis points or 75 basis points because it is getting close to a point where it's just going to simply hold interest rates where we are and not increase them any further? And if this is the case, is this the precursor to a major Fed pivot? Now, if the market hasn't sold off, and this is technically being interpreted as fairly negative news, is this the stock market priming itself for the next bull run? Or is this the top of the run before a massive stock market crash? But either way, I'm prepared. Either way, I'm ready to deploy additional capital into this thing. I'm continuously executing on my own investment strategies that I've done for years. I've been an investor for a good 20 years now. And I invest in a number of different things: stock market, ETFs, which are ultimately stocks, index funds, but real estate, businesses, home-based businesses, online businesses. And the key that you have to remember, guys, there's a lot of free money sitting out there. And with the market volatility that we're experiencing today, we've seen this before. This is not entirely new. There are some variables that are a little bit different. But if I think back to 2008, there was a time where, I couldn't go into the office, into my 9-to-5 job, without people talking about how bad the stock market was, how bad the housing market was. But at that time, I was looking at the market entirely different than how everyone else was viewing it. They were looking at their 401k values going down, their stock market portfolios, their brokerage accounts going down. But me personally, while I was concerned, I looked at it from the perspective of a lot of people are losing their jobs at that time. So I want to get another job. I was looking to increase my income because I was actually very, very concerned at that time. And what that allowed me to do was it allowed me to increase my income without necessarily increasing my expenses. And by doing that, number one, I was able to pay off debt a lot faster. And in this high interest rate environment, as the Fed continues to raise interest rates, you got credit cards that are raising their interest rates. Any kind of variable rate loan out there, the cost of carrying that debt is getting so much higher. We're reading that so many more automobile repossessions, cars are being repossessed more and more, and these banks are pulling these assets back. And so the thing is if you're carrying high interest debt, if you're not making money off the debt, I'm looking to get rid of it. And by getting rid of it, that would mean for me, I'm either going to sell the asset that is attached to this debt, or I'm going to aggressively pay this debt down and pay it off and eliminate that debt. That's just me. And, financial freedom is what you make it. The definition of financial freedom is entirely up to you. And it's going to vary from person to person. Some people say, you should be debt free. Others say you should have a lot of cash and leverage your debt. Me personally, I started off heavily into debt. Lots of credit card debt, lots of car payments. And when I say lots of car payments, there was a point at which I had 2 car payments because I'm a car enthusiast. I'm an automobile enthusiast, and I had 2 cars that I really liked. Couldn't afford either one of them. So what did I do? Well, I had great credit. So I ran out there, financed both of them. And, it was really silly, but, that's what happens when there's dumb money floating around. And there was a lot of dumb money floating around over the last couple of years. But I got smart over time. And I got to a point where I just said to myself, you know what? I got to eliminate some of this debt. These cars are both depreciating assets. And I decided that these toys they owned me. I didn't own these cars. Technically, the bank owned these cars. They were letting me drive them. So I decided, you know what? I'm going to get out of this thing because I saw what was coming down the pipeline. So I sold these cars and I purchased a car that was less than $2,000, believe it or not. And I drove that car until the wheels fell off. And this allowed me to invest more in the stock market. Even during a time when the stock market was crashing, I doubled down because I looked at the history of the stock market. I looked at the history of the S&P 500, and I was looking at these different ETFs and index funds. I was talking to different investment advisors, and there's a cycle that happens in our economy, and we're in that cycle now. But looking historically now, of course, the future history is no guarantee of future events, and the whole spiel. But the thing is I was looking at the S&P 500, and I was like, what? We've seen this happen before. And if you look at the statistics of how many wealthy individuals own stocks, like the percentage of stockholders is vastly skewed to the wealthiest individuals. And I began looking at it like, it's during these times of panic that the weak hands they're going to end up folding. But the smart money ends up doubling down on quality assets. The smart money picks up these homes that are at depressed values, whether it's a foreclosure, it's a short sale, or whatever the case is. They're picking up assets when the markets get weak. They're picking up great companies in the stock market when the times get weak. Apple pulled back a little bit yesterday when the Fed announced that there was going to be a 25 basis point rate hike. We saw a pullback from a number of other stocks, including I think I saw Microsoft, maybe Amazon pull back a little bit. But, you know, you never want to make a long-term decision based on a short-term incident. And me personally, there's a lot of great quality companies out there right now that are just not going away. And, you know, regardless of the fact that, you know, we're seeing a handful of banks collapse here, you know, you got Signature Valley Bank, you got Republic Bank, First Republic Bank, Signature Bank, and Credit Suisse. All of these financial institutions have collapsed, but there's still so many financial institutions that are still out there. Many banks are actually in a very good position. I mean, take JP Morgan Chase. They're in a position to spend $30 billion buying up assets from First Republic Bank. You don't just run out and drop $30 billion if you're not in a financially strong position. So, you know, I like to look at, number one, I'm always looking to diversify my assets. And I try to stand back and remain calm in spite of how much market noise and volatility is going on out there. So diversification is key, and eliminating debt that's not paying you. And if you're going to carry debt, you know, this is not financial advice for you. I'm just saying, from a person who started with less than nothing to, you know, building a portfolio to building a net worth of greater than seven figures, it's like I've learned a thing or two over the years. And I just like to share my experiences with you guys, because sometimes it does get really scary, and, you know, just kind of looking for direction. When I was getting started, I wish I had somebody that could kind of show me the way, give me the game. And it was hard to find people, and most people weren't not necessarily, you didn't really even know who to talk to. Like, who do you ask these questions to? And you want to ask the questions to the most qualified people. But anyway, what I realized was that starting out, I was upside down. I had a negative net worth, but I climbed out of debt, eliminated credit cards, eliminated the car payments. And for me, for a long time, I was completely debt free as I was getting out of debt and building wealth and increasing my net worth. Now, that was a very, very successful strategy that I had implemented over many, many years. And this was largely due to tracking my progress. So if you're not tracking your progress and, keeping track of where are you, how much debt do you have, what's your income like, how much total assets do you have? I created a very basic spreadsheet, and I would just track these things. It was no different than trying to lose weight or trying to build muscle. You want to track your progress so that you can make sure that you're moving in the right direction. Most people have no clue where they are financially, and so they never really get to where they're trying to go. Me personally, I began to just take a quick assessment of where I'm at, built out a spreadsheet, realized, oh, wow, things are really bad. Had all sorts of credit card debt, negative net worth, but slowly but surely, I climbed out of that hole. And anybody who's in that hole, I just want to be a little beacon of hope for them and let them know that, hey, anything is possible. But it's only possible if you think it is possible. So, never let anybody tell you what you can't do. And for God's sake, don't tell yourself that you can't do something. So anyway, bottom line here is always make income generation and increasing your income a priority, and never allow your income to be restrained or restricted or saddled down. And this is where a lot of Americans find themselves. Their income is already spoken for before they even get it. And this is why a lot of people find themselves living, quote unquote, paycheck to paycheck. Because when your income is basically spent before you get it, that is paycheck to paycheck. So, if you find yourself in that situation, you can't stay there. It's not safe. It's not safe. We've heard the Fed warnings. And if you're in a situation where you're paycheck to paycheck and you got debt and, credit card interest rates are going up, and if you happen to have purchased a house and that house happens to be on an adjustable rate mortgage, like an ARM, oh boy, it's going to get real, real dangerous. So, I've heard people, as these interest rates are adjusting, their mortgage payments are going up $100, $200, $300 a month, $400 a month. So, it could get really, really dicey. and you got to take action and take action quickly. So that means, starting a quick side hustle, generating some side hustle income, creating a little small home-based business. Do whatever it takes, even if it's just temporary. Get a part-time job, a little side hustle gig, whatever the case. Drive for Uber, drive for Lyft. Just imagine if you're driving, 10, 15, 20 miles to work every single day. If you drive 20 miles to work a day, that means you're driving 40 miles round trip. That's assuming you didn't make any pit stops. Well, just imagine if you signed up for like Uber or Lyft and you did a couple rides on your way to work. So let's just say hypothetically, it takes you 30 minutes to get to work. Well, if you, decided to go, clock in or start driving 30 minutes before you normally head out for work. So in other words, give yourself an hour, if I, and I don't drive for Uber, I don't drive for Lyft, but I'm just looking for opportunities where it's kind of like, okay, you're already driving. If you just make yourself available, I would think that you could probably make some extra money before and after work. These little gigs add up. Just think, now granted, if you guys want more information on side hustles and money making opportunities that can make a lot more than Uber and Lyft, definitely hit me up in the comments down below. But, if you're just trying to make an extra, $1,000 a month, you can certainly do that doing these ride share services. But think about it. Don't just sleep on the fact that it's only an extra $1,000 a month. That extra $1,000 a month could help wipe out debt quick, fast, and in a hurry. Because imagine, let's just say, you created a plan, you're working on getting out of debt, and, okay, with your current income, you're able to knock out debt at, $500 a month, maybe $1,000 a month. So if you're able to get out of debt at a rate of $1,000 a month by reducing your expenses, refinancing your existing loans, so refinancing high interest loans and getting lower interest rate loans, paying down credit cards, cutting back on expenses, reducing your subscription services that you're not using, that frees up a lot of cash. That frees up a lot of capital. And then you add in an extra $1,000 a month from a side hustle without necessarily increasing your expenses. Maybe you spend a little bit more on gas, but you know what I mean? You can wipe that debt out real fast. And debts that you don't necessarily need, like let's just say you have, an unnecessary boat. If you got a boat and you're paying a car payment on it and you can't afford, you're paying a boat payment on it and you can't afford it, sell that thing, right? And even if you took a little bit of a loss, right, it would help to get yourself out of that hole that much faster. Imagine you got a boat and that boat it's got a $20,000 note left on it, but you could only get $13,000. I would strongly consider selling the boat, taking the loss, and then now I only got to pay off $7,000. I can get out of debt and be done with this thing and move forward with my life. Now, this won't apply for everybody, but I'm just saying, like, sometimes you got to be willing to take a little bit of a L in order to get the W. And that's what I did, and for everybody's situation is different, but the key is, if you're going to have debt, make that debt be low interest, fixed rate debt, or that debt needs to be making you some kind of passive income, like a debt on a piece of property that's paying you passive income because you're renting it out. Or maybe you purchase some land and you're renting the land out to like a farmer or something like that. But the simple fact of the matter is, if you're going to have debt, leverage that debt and make sure that debt is paying you. So anyway, guys, drop me some comments down below. Let me know what you guys are thinking. Drop me a like, subscribe to the channel, and I look forward to seeing you guys and hearing from you guys on the next one.